You paid off your house. Zero mortgage, nothing owed. So, why do so many retirees who own their home outright still run out of money before they run out of years? A paid-off home feels like the finish line. But the way most people think about that asset is costing them options they don't even know they have. Here's the real value of that house, and it's not what you think. And I'm going to walk you through exactly what that home is really doing for you and what it isn't. I'm Jordan, and if that sounds useful, do me a quick favor first. Hit like and subscribe. Not for me, but because it helps another retiree who's staring at their own paid-off house wondering the same thing actually find this video. All right, let's get into it. Here's what we're covering today. Most people think a paid-off home means one thing: no more mortgage payment. That's true, but it's the smallest part of the story. There are 3 ways a paid-off home actually shapes your retirement, and most retirees only understand one of them. We're going to walk through all 3: the expense lever, the liquidity trap, and the tax advantage nobody explains clearly. By the end, you'll understand what that house is really worth to you, not on paper, but in your actual monthly life. Let's start with the one most people already sort of know, and then get into the 2 most people miss completely. Lever number 1, the expense lever. This is the part everyone gets. No mortgage means one less bill. But here's the piece people miss. It's not just that you save money each month. It's that a paid-off home lowers the amount you need to pull out of your savings every year to live. Financial planners call this your withdrawal rate. It's just the percentage of your total savings you take out each year to cover your bills. If your mortgage was $1,800 a month, that's over $21,000 a year you no longer need to generate from savings, Social Security, or a pension. That might mean the difference between needing to pull 5% of your portfolio a year and needing to pull 3.5%. That gap matters enormously, especially in the first several years of retirement, when a bad stretch in the market combined with heavy withdrawals can do lasting damage to your savings, something often called sequence of returns risk. A paid-off home doesn't just save you money, it buys you flexibility to not sell investments at a bad time. Do you know what your monthly expenses actually look like with the mortgage gone versus what they look like with it? Most people have never actually run that number. Here's the thing, though, that expense relief isn't the same as having cash in hand. Which brings us to the trap. Lever number 2, the liquidity trap. This is the one that catches people off guard. Your home might be worth $400,000, $600,000 more. But that number sitting in your home's equity doesn't pay for groceries. It doesn't pay your property tax bill. It doesn't pay for a new roof. Home equity is what's called an illiquid asset, meaning it's not cash, and turning it into cash takes time, effort, or a loan. Meanwhile, the bills tied to that house don't disappear just because the mortgage did. Property taxes, homeowners insurance, maintenance, repairs, those keep coming, and in a lot of parts of the country, they've been climbing faster than general inflation. Some retirees find themselves what's sometimes called house rich and cash poor, sitting on a valuable asset while feeling squeezed every month. There are ways to access that equity if you need to: selling and downsizing, a home equity line of credit, or in some cases, a reverse mortgage, which lets certain homeowners convert part of their equity into cash while still living in the home, under specific rules and costs you'd want to understand fully first. None of these are the right answer for everyone. They're tools, not verdicts. You're not behind if you haven't thought about this yet. Most people don't, until they need to. The question worth asking yourself is simple. If a $15,000 expense showed up tomorrow, a roof, a health cost, a car, where would that money actually come from? Take a breath, friend. This isn't about scaring you into a decision today. It's about knowing your options before you're forced to choose one under pressure. Lever number 3, the tax advantage almost nobody explains clearly. This is where a paid-off home quietly does something powerful. First, there's what economists call imputed rent, the value you get from living in your home rent-free. That value is real. It's worth thousands of dollars a year compared to renting the same place. And unlike almost every other form of income in retirement, it is not taxed. Compare that to pulling money from a traditional IRA or 401k, where every dollar you withdraw generally counts as taxable income, and can also affect things like how much of your Social Security gets taxed. Your home doesn't do that. It just quietly saves you money, tax-free, every single month. Second, if you ever do decide to sell, there's a real and well-established tax benefit called the Section 121 exclusion. As of now, a single homeowner can typically exclude up to $250,000 of profit from the sale of a primary home from capital gains tax, and a married couple filing jointly can typically exclude up to $500,000, as long as you've owned and lived in the home for at least 2 of the last 5 years. Rules like this can be adjusted over time, so it's always worth double-checking the current details before you rely on them, but the underlying benefit has been in place for a long time. That's a meaningful cushion if downsizing ever becomes part of your plan. Have you ever actually calculated what your imputed rent is worth to your monthly budget? Most people never have, and it's often bigger than they'd guess. Let's make this real with an example. Meet Tom and Linda, a composite, illustrative couple, not real people, but a stand-in for a situation a lot of retirees find themselves in. Tom is 68, Linda is 66. They paid off their $450,000 home 4 years ago and are debt-free. Their Social Security and a small pension cover their basic bills, but the mortgage used to eat up almost $2,000 a month. And now that money simply isn't a monthly obligation anymore. Lever number one, working quietly in the background. But last year, their roof needed replacing about $14,000, and they realized almost all their money was tied up in either the house or their retirement accounts. That's lever number two showing up. They didn't have a dedicated cash cushion, so they used a portion of a home equity line of credit to cover it, rather than pulling a large lump sum from their IRA in a single year, which would have pushed them into a higher tax bracket and increased what's taxed on their Social Security. That's lever number three, working in their favor. By being thoughtful about where the money came from, they avoided an unnecessary tax hit. Tom and Linda's home isn't just a paid-off asset sitting there. It's actively lowering their monthly needs. It's a resource they can tap carefully when something big comes up, and it's quietly saving them tax dollars every year just by existing. That's the real, layered value of what they own. Not just no mortgage, but all three levers working together. Now, I want to be honest with you. This default way of thinking about a paid-off home doesn't fit everyone. If your health means you may need to move into assisted living or a care setting sooner rather than later, the calculus around holding onto that equity versus accessing it changes. If your savings outside the home are thin and your monthly income barely covers essentials, leaning on home equity sooner through downsizing or a line of credit may matter more than optimizing for tax efficiency later. And if you've recently lost a spouse, filing status and tax brackets can shift significantly, sometimes making a paid-off home's tax advantages even more valuable, sometimes changing the math on whether to stay or sell. There's no universal right answer here. There's only the answer that fits your specific numbers in your specific life. So here's what I'd actually do this week. First, write down your true monthly expenses now that the mortgage is gone, including property tax, insurance, and a realistic maintenance estimate, not the number from before you paid it off. Second, figure out where you'd actually get cash from if a $10,000 to $15,000 expense showed up unexpectedly next month. Third, look up the current Section 121 exclusion rules and IRMA thresholds for your filing status, since both get adjusted periodically, and the exact figures matter for your situation. And fourth, if you haven't already, have one honest conversation with your spouse or a trusted person about what you'd do with the house if one of you needed to move into a care setting. None of these require a financial advisor to start. They just require about an hour of your time. Quick and important note here, friend. This video is for education only, not financial, tax, or legal advice. I'm Jordan, and I'm not a registered investment advisor, CPA, or attorney. Everyone's situation is different, and the numbers and rules mentioned here can change. So please talk to a qualified professional before making any decisions based on what you've heard today. So here's the takeaway. A paid-off home isn't just the absence of a mortgage payment. It's an expense reducer, a resource you can carefully tap when life happens, and a quiet tax advantage all rolled into one. Understanding all three lets you use that asset the way it's actually meant to be used, instead of just sitting on it and hoping. That's how we do this, friend. One clear number at a time, no shame, just clarity. If this helped, hit like and subscribe so it reaches someone else standing where you're standing right now. And if you're wondering what order you should actually pull money from, savings, retirement accounts, or home equity, when a big expense hits, that's exactly what I break down in the next video. I'll see you there.